Hello viewers, my dear friends, my name is Ashok Sen Gupta from School of Management Sciences, Lucknow. Today our topic of discussion is project financing and budgeting. This topic belongs to our subject project management in MBA 4th semester. Previous topic was discussed on the aspects of cost component, cost management, various type of cost. In previous lecture we discussed about the fixed cost, variable cost, recurring cost, non-recurring cost, direct cost, indirect cost. Another thing in the project is financing and budgeting. If we estimate the cost, estimate all the things, even though we need finance from various sources, we need proper budgeting of that. So, in today's class we will discuss what are the various sources of budgeting, what is project financing. So, project financing is a loan structure that relies primarily on the project's cash flow for repayment, with the project asset right interest held as a secondary collateral. Project financing is especially attractive to the private sector because companies can fund major projects of balance sheet. Project finance involves the public fund of infrastructure and long term capital incentive project. This often utilize non-course and limited resources. So, financing means availability of fund, finance means to get the fund when it is required, and financing means project financing means to collect the sources of fund for the project, because projects are heavy capital intensive in nature, and is a long term benefit. They provide long term benefit, but initially they required a huge fund, and no entrepreneur, no firm takes risk to put their whole overall money in a project. Therefore, they looking for the various sources of finance, investors who invest in their company, in projects, and against that they are ready to pay the interest, dividend, etc. While doing so, companies reduce their risk, reduce their financing risk. If company take a loan from bank, that means bank sharing their risk. Bank approved that loan because bank also feels that this project is good, this project after completion of the project bank get good amount of interest, and also their money will flow and it not with NPA. Similarly, various private companies, private person, individual persons lended their money in different companies, in projects, to get interest on that. Project debt is typically held in a sufficient minority subsidiary or considered in the balance sheet of the respective shareholders. So, overall project financing involves project funding, in which we required a huge amount of fund from public, from bank, from other sources, and provide them interest against that. Now, what is budgeting? So, project budgeting is a total sum of money allocated for a particular purpose of project. So, if you having a project A, then you have to prepare a budget for only A, because there is a different specification for different project, different requirement for the different project. So, every project having its own goal, every project has its own goal. Goal of the budget management is to control the overall cost of the project. If company do their work, do the overall project within a given budget, then it always helpful and successful project. If company deliver their output within the budget, then it will be a benchmark from them. If company managers do the project on time, on scheduled time, then it will enhance his career opportunity also. Project budgeting is such an important factor, because if you delay in the budget, then it will hamper your project, and in most of the cases project has stopped for a long period of time, and when your project has when project is stopped for a period of time, it will increase the overall costing, because day by day due to the inflation, cost of each and everything like raw material, human resource, salary, etc. increases. So, overall cost will increase, then company need to revise their budget, So, project financing and project budgeting must be equal. If you having budget of 50 crore, 50,000 crore of any, your financing should be according to the budget. If you get more finance, then you have to pay more to the lender. If you borrow more amount, then you have to pay more interest, and maximum lending company not give you 100% project finance. You have to pay 25%, 30% out of your pocket, and remaining will be financed. So, if you worked on budgeting, then it also helpful for maintaining the project finance, also maintaining the interest rate, because interest rate is fixed and it is long term. So, you need to pay for not for a 1 year, for maybe possible for 10 to 20 years you are paying the interest to the bank. This is fixed. So, it give directly impact to your profit and loss account. Okay. So, project financing and project budgeting must be balanced. So, what are the various sources of financing? So, project financing means obtain a fund for individual product, long term infrastructure, public services. Many businesses use the fund to take care major projects using non-recourse or limited financial structure. There are several ways to secure project finance, such as investor loan, private finance, equity finance, grant, etc. If you are for an NGO, government give them grants for their project, like rehabilitation of slum area, proper food nutrition, food for the malnutrition child. These are the projects running by these projects are running by various organizations, international organizations. So, grant is also finance, and grant given by the government to the basically to the NGOs for social development. For businessmen, funding project funding is by the banks, equity and other private players, and all need to repay the loan. So, first is business angels. We also know them, angel finance. Our vast experience in the industry, they operate in private investors may invest in a company by capital gain. and investment is the place of board of equity stake. Business angel financing are the private investor or a company having a some people, they are a company, their main objective of that company to lending the money in different projects, and against that they part of that their equity stake, but they charge heavily, their interest is high, but additionally they invest in new kind of project startups, also known as angel investors. So, angel investors are the persons who invest their amount, their money in the startups, new ventures, new kind of innovating projects, because bank afraid to put their hand in new startups, they feel afraid that their money will become loss, amount will NPA. Angel investors are risk taker, but they charge high rate of interest from the businesses or project companies who are for the projects. Venture capitalist. Venture capitalist are the sole proprietor company or private firms who invest their money to the new startups, especially new startups. If you talk about various new startups like Flipkart, Mantra, etc., Ola, Olex, Oyo Rooms, there are various startups are in India, and if you see big venture capitalist firms invest their amount, invest their money in these kind of startups, in these kind of ventures, in these kind of projects, because these projects are new in the market. Similarly to the angel investors, but difference is angel investors are individual, but venture capitalists are a firm. They are a firm of having a sole proprietorship or a partnership firms, and they invest their money for projects. Against that, either they charge high rate of interest, second also the part of their stakeholder, they are the stakeholders, they part of they having the 20-30% shares in that company, because these people, either angel brokers, angel investors or venture capitalists, they are very specialized people. They know which company is going to grow or which will not. They are risk taker to take the risk and put their money, and because of them we have some good startups in our country. We know them, we are using them because they are new and we are using them. And one of the is Oyo Rooms. So, Oyo Rooms are the company or is one of the startup. It is a project and it is a growing project. Now, it is worldwide. Therefore, it is important for the economic development also. If project is not funded by the people, then we do not have the competition, we do not have the new things in the market, we do not have the new innovative ideas there is a lacuna in our system in India, that we have a good brains, we have a good people having good ideas, but their idea will not came into the picture because of the lack of fund, because of the lack of fund, lack of backup, because person who have an idea may be possible do not have the fund, and nobody ready to give them finance to start their project. That is why we are lacking in patent filing, we are lacking in copyright filing, we are lacking in innovations in compared to the US. So, venture capital is also a project source or funding source. Next is loan for a business. As you know, loan for the business from the banks. Loan for the business is secured or unsecured also. Most of the business are secured loan against which banks or financial institution having take the mortgage of their property, and against that they provide them loan. For example, if they have the property's valuation is 1000 crore, they collect the papers, mortgage it, and pay near about 75 to 80%, sometimes 80% loan against that property. So, this is also known as loan against property, because it is secured loan. Unsecured loans, business loans, are those loans where the owner of the firm get fund from his friend, family members, and they do not ask anything as a security, they are unsecured. So, in balance sheet, if we talk about the balance sheet of the firm, we saw there are two types, secured loan and unsecured loan, liability side. So, secured loan where we have a specific kind of mortgage, and unsecured there is no mortgage against that. So, banks, financial institutions always will to having the mortgage loan to secure their fund, to minimize their risk. If the company get insolvent, not able to provide the loan at proper time, they will sold out that. We heard lot of about the gold finance, loan against gold. Start your business and put your gold in bank and get the loan against gold, but does not mean that you get the exact value. You first of all you have to pay a high rate of interest rate. Second, the valuation, you get the 80 to 70% valuation of the gold, but it is instant amount you will get, because gold is liquid money, it is near about to liquid, then you can get instant money to start your business. Government also started, bank also started mudra loans for startups, for small scale industries, small businesses, and these are all part of loan business. In loan business, there is an agreement between the borrower and the lender, and they sign the various documents, and they agree on the time of tenure, specific rate, fixed rate, flexible rate, etc. Share capital, it is one of the way companies get finance, especially if you need huge finance and you want to share your stake part to the public. In last 15 days to 1 month, lot of IPOs are launched like Zomato, Relaxo Ring, IPOs are launched by the company to enhance their businesses, and against that they sell their stake to the public. Investor expected good return like dividend from the share capital, and sometime they invest in a company to increase their wealth, and after certain time when they sell their share they get the capital gain. So, if today for example, share of a one company is 100 rupees, then an investor expected that if it become a 200 rupees, I will sell it and get a profit of 100 rupees per share. So, shareholder get profit from the dividend. These shares of profit is derived from the ordinary shares. So, share capital is a form of businesses where form of source of finance where company sell their stake, sell their shares to the general public, to the financial institutions also, and collect the fund. Against that they pay dividend against out of their profit. Overdraft. This facility is given to the companies having a good reputation in the bank. That is overdraft facility is given to the bank by the bank on current account only. If a company A, suppose if a company A, firm A link with bank B and linked with bank B having a good reputation of last 5 to 6 years or more than 6 years, okay, and bank feel that the company is good and they have a good transaction, they have a current account and they have good transaction daily basis, monthly basis, good transaction, then in some cases if the firm do not have fund to pay, if the firm having for example, if they have to pay 10 lakh rupees and in their account there is only a 5 lakh rupees, then 5 lakhs is overdraft provided by the financial institution or bank. This facility depends on the relationship, it depends on the limit of the overdraft, depends on the relationship and limit of the overdraft. Bank charges interest on the overdraft, but meanwhile if a person get the money on proper time, then it will be helpful for him to pay the expenses. Generally this overdraft facility is used by the firms for paying the salary, for paying the vendors payment like raw material payment, for the wages payment, etc. And when they receive that payment by selling the product or from the debtors, they pay back to the bank. So, overdraft is a source of finance, but it is not a long term source of finance, this is a short term source of finance, while share capital are the long term source of finance, because when you issue the share to the public, it is now depend on the public how they manage it, how long they manage that, because now it is in market, people sell it, purchase it, sell it, is a continuous process. Therefore, overdraft facility is basically used by the existing firm, not a new firm. New firm will get difficult to pay or difficult to get the overdraft facility, because it is totally new, and overdraft facility given to that firm only those are having a good reputation with the bank, they have some good records, previous records. For the new companies it is difficult to maintain the working capital. This is one of the factor where new firms failed after a few months, because if they after a few months, because if their product not sell properly, they not get the revenue, and if they not get the revenue on time, it is difficult to pay them difficult for them to pay the overheads, and bank not giving them any overdraft facility because they are truly new. So, in this case, the only way to put down their business, shut out the business. During the lockdown period, there are a lot of businesses were started before the lockdown, closed after the lockdown, only because that they are not able to maintain the running expenses, recurring expenses. Debentures. Debentures are the outsider debt. It is not a loan by the bank, but it is a kind of capital market instrument like a share, but shareholders are the owner of the fund, while debenture holders are the not the owner of the fund. They are outside parties where the company need to pay them fixed interest yearly to the debenture holders. Debenture having a certain tenure like 5 years, 10 years, 8 years, 3 years. After that they the company reimburse or repay their whole amount to the debenture holders. They are outsiders, but overall interest paid to the debenture holders is less, it is quite cheap in compared to the equity shareholder. That is why we say that equity interest is equity cost is expensive than debenture cost. So, debenture are a kind of loan from the outside party where company issue the certificate to the debenture holder and collect them money from them and promise to pay a fixed interest rate on a first period of time, even they have a profit or not. So, this is one of the sources of finance. So, my dear students, today we in this topic we discussed about the various sources of finance available in the market for any project, from venture capitalist, angel investors, bank loan, share capital, debentures, etc. So, I hope you understand this topic. Thank you for watching this video.